Hello, options traders. Steve Ganz here, and I always tell people on my videos to let me know if you have any questions or if there's any particular topics that you would like me to cover. And Carrie Tom 4731 posted, now it says 3 hours ago. This is a little while back, but I capture these. I do listen to what people want to see. And he or she, I'm assuming he is specifically asking that the poor man's covered call still isn't quite resonating or registering with them as far as how the whole thing works, and then also how it is different from a real covered call strategy. So that's what I wanted to cover in today's video, was just to kind of show what is a poor man's covered call, why is it called a poor man's covered call, and how does it work differently. So to take a look at that, this is a poor man's covered call. A poor man's covered call is essentially a diagonal spread. Now I'm going to get to this back image here in a minute, but I'm going to start off here. So let's just take a look at the two options that I'm using here. So I purchased a long call, a 200 long call. Now Apple is currently trading in the 226 range. So this is fairly deep in the money. We can see the delta on this is about 0.8283. So this fits the requirements that Carrie Tom mentioned. So again, I'm purchasing this long call. Now this long call doesn't expire until March 21. So this long call is going to carry me out till March 21. So in a regular covered call, I don't own this long call, I own stock instead. We're going to look at what that means and how those two differ here shortly. But right now, for the poor man's covered call, I am buying this long call that is in the money. Now, what I'm doing in order to juice that trade, if you will, if I only had the long call, let me just exclude this for a moment. If I only had the long call, this is what my P&L diagram would look like. I could lose the total amount that I'm paying for that long call if Apple were to tank on me, if Apple were to slide backwards, and even if Apple stayed right where it was and didn't go up in value, I'm going to lose money. I'll lose about $1,052. I need Apple to get above, in this case, this roughly 238 mark before the long call would start to become profitable. But you notice there's no upside cap on this. This thing can continue to run up. If Apple were to rally up to 300, I'd have a very nice profit in that trade. So what does any covered call do, whether it's a poor man's covered call or whether it's a regular covered call? By selling a call against my underlying position, I'm essentially capping my upside. So if I'm going to do this, I am making an assumption in this case that, this strike is October 18th. We're currently August 25th. So if I am selling this October 18th, I'm basically saying that, you know what, I don't think that Apple's going to go above $230 by October 18th. Or I'm saying that I don't think Apple is going to be above $230 on October 18th. Maybe it goes a little higher in the meantime. But essentially, by placing this trade, I am making a bet, if you will, that Apple is going to be below 230 somewhere. And ideally, it's going to be somewhere in this range. It's going to be above the 222 range, but below the 230 or so range. That's where this trade has its peak performance, if you will. Now, you'll notice that what I'm picking up here, I'm spending on this long call, I'm spending $37.60. Now, I'm offsetting that price. If I only had that long call, let me exclude this again, you can see my max loss here is just shy of $4,000. By adding in this long call and taking in $695, I am essentially reducing my risk in that trade by that amount of money that I'm taking in. But everything in options is a trade-off. So by taking in that premium, if Apple were to blow above 230, I'm not participating in that. I'll still have a profitable trade, but I won't have a hugely profitable trade if Apple goes up to 260, 270, 300. So again, as a trader, I'm making a decision here that I don't think it's going to go above a certain price. And of course, cool thing about OptionStrat, I can set that price whatever I want it to be, and I can see how my P&L might vary accordingly, okay? So that's one of the awesome things that I can come in here and I can play with as a trader. So let's just say that I want to go with this 230. So this is a poor man's covered call. Now, why is it called a poor man's covered call? Well, let's take a look at this. How much does this trade cost me to be in right now? Well, this trade costs me $3,760 less the premium I take in of $695. So I'm essentially spending $3,065 on this trade. That is my max risk in this trade. The amount of margin that I need to have in my account to put on this particular trade is that $3,065. Of course, depending on what type of margin you have in your account, whether it's in an IRA or a cash secured account, etc., those things can vary a little bit, but in general, you have $3,000 excuse me, in risk in this particular trade. So what if I don't do this? What if I have a regular covered call? Let me just expand this out. If I have a regular covered call, my max risk is whatever I'm spending for those 100 long shares, because theoretically, Apple could go to zero. Now, obviously, I don't think any of us feel that's going to happen. If that does happen, we got bigger problems in the world than Apple going to zero. But the point is, depending on my account type, it could tie up $22,000 in buying power in my account to put on this particular trade. In this particular case of a covered call, I have 100 shares of the underlying stock. I'm still selling the exact same call against that. In this case, let's see, I must have something different in this. I'm using that October 18th expiration. So anyhow, so I'm picking up less. Let me go back and see what this one was. 230, that's the difference right there. I think I have this one at 250. So if I bring this back to the same strike, I'll be picking up the same premium of that $695. So that's a standard covered call. In the standard covered call, I have this amount of essentially risk in the trade. I'm using up a massive amount of additional buying power. Now, one other factor that comes into play here is that this covered call, I am gaining premium on. This thing is decaying out from under me, and the theta decay is, it starts off at, I guess that would be $8 a day, essentially. Now, in the other trade, that theta decay will not be as high. If I come in and I look at the overall theta decay on this trade, it's significantly less. The reason it's significantly less is while this covered call is decaying in my favor, this long call that I bought is decaying against me. So that's why theta on this trade is only 359, where theta on that covered call is more than double that amount, because I don't have that long call that's decaying. Stock does not decay. Stock does not have theta. So this is the difference in a regular covered call right here versus the poor man's covered call. Again, the biggest difference really being the amount of money that it's going to tie up in my account to be in one trade versus the other. So, Carrie Tom, I hope this answers the question that you posed. Thank you so much for sharing that question, and hopefully other traders find this helpful. If you like this sort of content, please give me a comment down below if there's some specific type of trade or comparison that you would like to see in the future. Give me that comment as well, and I'll add it to my list. So thanks so much, everyone. Take care. Have a good week trading.